that should be done. So, hi everybody, thank you very much for joining us today. Jacky Chan here is our head of investments. I'm Jatin Ondhia, CEO of Shojin. Over the next kind of 20 minutes or so, we're going to talk a little bit about the market more broadly, what's happening in the UK real estate market. We'll talk a little bit about what has been happening and then what we expect to happen over the coming months. But this is very much an interactive kind of session, and we really welcome questions. The chat function is open, so please do post any questions on there. So let's just jump straight into it. We'll start with, oops, hold on, I'm going to share. Okay, you should be able to see that now. And we're just going to go into just various aspects of the market. Now, before we do any of that, I'm just going to start by, just for some people that might be new, just explain very briefly who Shojin are. So we provide investments into the real estate sector in the UK. We specialize in development projects, and we do this on a fractional basis. So what this means is, whereas previously you would have needed a lot of money to get into real estate development, investing, through our platform, you can invest in those same projects that, say, family offices invest into, but you can do it on a fractional basis. Our minimum investment right now is only £1,000, so it enables you to test drive the process. But also the idea behind keeping the minimum investments quite low is so that you can diversify your investment. So it doesn't matter whether you want to put in 5K, 10K, 50K or 500K into a project, you still go through exactly the same process and you earn the same returns. So if you'd like more information, please do look at the website or get in touch with us. But for now, let's jump into what's been going on in the market. So, Jacky, do you want to start with this one?
Yeah, so I think we all have seen some headlines around in the news. The UK economy, like people always ask, well, why should I still invest in the UK? Like, should I still invest in the UK, or should I actually look elsewhere? A lot of investors that I speak to, like obviously have portfolios in US stocks and shares in Asia and around the world. So what's the attractiveness of being in UK? So I think one of the key things this chart is actually showing is that apart from COVID, right? So which is one in a lifetime scenario, hopefully. So UK in general, the economy is a very, very stable economy. Doesn't have too much of the ups and downs over the course of cycles. So the volatility wise isn't that huge. So what this provides for investors is that certainty, like stability, preservation of capital, preservation of wealth. That is where what UK does. Where compared to Asia, for example, or even in US, some segments, because US is also huge, right? So it could be a lot more volatile. Like you can get the booms and busts a lot more. UK in particular actually gives that, and the real GDP growth is still at a positive territory in the latest numbers, like it was 1.3% year on year. It has creeped up a little bit from like flat growth previously. So we're kind of getting out of the post-COVID drag on the economy.
Yeah, I mean, look, I would add to that as well. I mean, I speak to a lot of international investors, and the UK, I've said this a few times since Brexit, really, the UK looks like a basket case sometimes on the world scene. However, it is still considered a stable country in which to park money. And one of the places people always park money in the UK is in real estate. We've seen the central London market come off because obviously a lot of non-doms are being chased out, but that doesn't change the fact that it's still a safe haven for a lot of investors around the world. And interestingly enough, a lot of Middle Easterns that had moved money into the US market over the last several years are now shifting, not massively, not wholly, but certainly increasing their allocation back into the UK market. So that's kind of positive. There's a number of other stats we can focus on here as well. I mean, inflation was crippling a while ago. But it is now starting to stabilize. It has been a bit stubborn, let's be honest. For the last few months, it's been, I mean, you can see here, it actually came down to the right level and then kind of moved back up again.
It doesn't help when we have a new government, the Labour government helping.
Yeah, who just wants to give out loads of money to everyone.
Yes.
And stoke that inflation
and
a bit
increasing
more.
Taxes, national insurances, and so on.
Increasing national insurance. Obviously, we've got the budget coming up, and I could say many things about what our expectations are, but I think we all know that it's not going to be massively positive for anyone that's actually kind of made sensible decisions, such as saving money in ISAs or working hard to earn more money. There is definitely going to be more taxes. There's definitely going to be changes made to things like tax-free savings accounts. However, as much as I could rant about all of those things, the country needs to get back onto a stable footing as far as the financial markets go, to bring down our borrowing costs as well. And interestingly enough, the borrowing costs have come down a little bit. There's been a lot of uncertainty in the market. The borrowing costs had gone up, but in the last week or two, it's come down a bit.
The mortgage rate in particular.
Mortgage rates, but also the government's own borrowing costs.
Yeah, gilts, 30-year gilts.
So I think the global markets are looking at it as though, we're taking responsibility for our debt. We're not out of the woods, but as long as we make sensible decisions, our government borrowing costs should come down, and that should then feed more into the rest of the economy, because remember, currently we're paying a lot of interest as a country. That's on inflation. Hey?
And in terms of average pay rises, I think overall the country has always been on a very long-term steady growth. And it has accelerated in 21 post-COVID. And that stoked a lot of the inflation problems back then, 21, 22. And hence inflation was up like 10, 12%. And then wage rise, people demanded more pay in order to cover for inflation. And that went into a spiral. And the government had to increase, central bank has to increase the rates to actually put it back into control. And luckily, and what we can see right now is that while inflation is still stubborn and actually crept up a little bit till 3.8%, but wage rises have still been on the up. It hasn't really dampened that too much. And so if we look at these figures, it does show that the economy is resilient. Like, it is challenging times. I think everybody can feel the pinch in the last 2 years or so, but it is still very resilient, like compared to some other countries. If you look around the world, would have like economic problems and troubles with where interest rates are. So this also shows the strength of the economy in the UK, and why, go back to the very first question, why people should invest or would want to invest in the UK.
A lot of this then kind of feeds into where we expect rates to be. Now, if you'd asked me yesterday, and in fact we did discuss this yesterday, I would have said there's no chance of another rate cut this year. However, but given that inflation came in at 3.8 and that was below the 4% that was expected, there is now talk of potentially there being one more rate cut this year, which will be welcome news to everyone. But given how much bad news comes out all over the place, I'm not holding my breath. If it comes down, it's great. Where I'm working personally on the assumption that we're not going to get another rate cut. How does that feed into what happens in the market, real estate market, and obviously the loans that we are funding? But fingers crossed, we might get some good news soon.
Yeah, so how I see the rates is that if inflation right now is at 3.8 and we look at where it was previously at 10 and then came down to 2, bounced back to 3.8 in the previous chart we just saw, like if it stabilizes at like currently at 3.5 to 4% type of levels, I would expect the interest rate to be slightly below inflation. Like that's historically, that's how always trended. Like if it's 2%, you have your interest rate at like less than 1%. And then now if it's about 3.8, 4%, interest rate could come down to about 3.5 and that's about it. Like it can't go any too much further away from inflation. Otherwise, it will stoke inflation further. So that actually is where I would see the rates stabilizing right now, given where we are at, unless inflation actually goes back down to like 2% or even further. But looks like we're now finding a floor.
But even then, I mean, even when inflation is down to the 2% level, I think one of the things we have seen historically, there is a natural level of interest rates, which is somewhere between 3 and 4. And in fact, I think that's actually what this is showing, because interest rates won't just keep coming down. Those days are long gone, right? So
it was 0 to 1% up until 2022.
Yeah, this was a once in a lifetime, opportunity. I don't think I'm going to hold my breath to come back again. But let's see what that means for transaction volumes. And this is UK residential transactions. And I mean, one thing this is showing, if you follow the previous graphs, one thing we know, and we've seen this on the front line, that the past few years have been horrific. I think that's the only word I can use, because there was so much uncertainty in the market. You had significant cost inflation on UK real estate development, which I'll go to in a minute. Confidence dropped. Think about it. As soon as rates shot up, all the first-time buyers just dropped off. They'd never known rates that were so high. A number of things happened, and then all this uncertainty, obviously the wars going on and so on, led to a decline in transaction volumes. And so some of you will know this. You'll be in transactions from what I call the 21 to 23 vintage. The transactions entered into during that time have struggled to exit, because what's happened is, even as they were building, there was a lot of costs were going up. But then the problem was, even if they finished the development, there was no way to exit those developments because people were just not buying. Transaction volumes are just not that great. So over here, you can see on the far right-hand side, this is where we are right now. I mean, it has stepped up a little bit from earlier in the year. But again, these are not fantastic levels. And a lot of people right now are just waiting to see what happens in the budget. It's a bit like when the election happened. Everyone kind of knows there's going to be pain, but once you've got that, once we're past the budget date and we all know what's happening, people can start planning again. So if they're going to be moving house or buying new properties and so on. So I think we're in a bad place, or a challenging place, I should say, at the moment, and have been for quite a while. But I don't think things are going to get worse from here. If anything, we are feeling and sensing on the front line that there is appetite to get back into the market. We'll look in a moment at house prices and rental values and so on.
And on this chart, like it's been zoomed out. I have to take into account. But if you actually look closer, it looks very stable, but it's actually not that stable, because if you zoom in a little bit in 22, 23. It's actually almost a 25% drop off, during that period. And even beginning of this year, you look at how horrible it was. It was like 40% drop off from where it previously was on an average basis. And this is where the whole market, in terms of transaction volume that Jatin just mentioned, has been a challenging time. Compared to, if you look back at pre-COVID days, it was very stable at 100,000 transactions a year, 2016 to 2019, until COVID hit, and then we got that volatility we saw.
Yeah, let's see how that feeds into other things. So, house prices. Now, this is quite interesting. Historically, we're all used to seeing house prices shooting up in value, but for several years now, we have found that house prices have pretty much stabilized. You might read a good news story coming out from Rightmove or someone saying, great, house prices are up this quarter. But weirdly enough, Halifax will be saying, actually, they're down a bit this quarter. The reality is they haven't really moved, right? They're pretty stable, and you can see that quite clearly here. Anything more to add?
Yeah, I think there are two factors in place driving this house prices. One is rents, and rents are driven by income, and then the second is yields, or so-called cap rates, which is driving the rental yield required for buying a property. So what we've seen in the last 2 years, because interest rates have gone up, mortgage rates have gone up, the required, like for anyone who wants to buy a property right now, I will demand a higher yield or higher return on my property, like in order to actually even get me remotely attracted, compared to like 3-4 years ago. So, but why has it still been stable in terms of property prices? Because if I want higher yield, it means that I need a lower property price. So what it was, it reflects that the rental growth has been offsetting some of that, and the rental growth is always driven by the income. So that's why you saw the wage chart that we just showed earlier, as it was steadily growing. That basically has been driving rentals on a steady growth, or so-called affordability on a steady growth, and that offset the higher yield requirement by potential buyers, and hence property prices have been pretty much stable. Like it's one offset the other. Like it hasn't caused collapse or crashes because sellers are not in a rush to sell. Buyers are like only buying at the right price and opportunity. So it has been in the quite stable market in terms of property prices that what we've seen in the last 2 years.
And yeah, I mean, we'll look a bit more at the rental numbers in a sec, but it's worth talking about this one. So this is talking about average house prices. You can see that London obviously has pretty much stagnated, but some of the biggest growth has been seen in areas outside of London. The Northeast, Northwest and East Midlands are definitely showing the biggest growth, which aligns with something that I think we've been saying for a while, and we've been seeing for a while on the front line, that some of the better opportunities tend to be in those regions. There's also a very growing kind of base of kind of young professionals, if you like, in those areas. So somewhere like Manchester, we've spoken about this before, started over a decade ago with the media city and everything, and it's been attracting a lot of young talent. Law firms have set up their accounting firms and so on. So it's now got its own kind of, it's like a mini London. I know they'd hate me saying this, but it's like a mini London. It's more affordable. It's been a lot of development going on there, and I've always worried about oversupply in somewhere like Manchester, but actually it seems to be holding quite firm. The other places are seeing similar growth. Leeds has come out as quite a strong place for growth, because it seems to be almost like a mini financial centre in itself. So there are these things going on in the regions which is creating value and opportunity, which also weirdly correlates with some of the things we're seeing. We've been seeing great deals in the regions for a while, but London has actually softened, and as in softened in terms of the deals we're seeing, the land values have softened, which means more deals are now making sense for us. Whereas for a long time we didn't do many London transactions. We're seeing more transactions now that actually do stack up, and I'll talk a little bit about them later. Yeah. Do you want to say anything more on this, or shall I move on to the rental?
No, then we can move on to the next one.
Yeah? So this is quite an interesting graph. Have you had a chance to look at this graph?
Yeah.
Yeah. I thought this was quite interesting. If you look at the rental price growth, and how it's differentiated across the various areas. So I was quite impressed by this, the Northwest, which obviously incorporates Manchester. I would have expected rental values to fall given the sheer amount of development going on there, but it just keeps getting stronger. Anything more?
No, I think, as I mentioned, I think the key, like if you plot this against the wage growth, that is actually very correlated to that. Like I think a lot of times, like in the market or in media coverage, a lot of people talk about supply and demand, because the supply is easy for you to see, like because it's buildings that builds up. But at the end of the day, like from my experience in the real estate market all these years, like property prices and rents, like rents in particular, are completely driven by people's income and affordability, because it's about how much I make and how much I can afford to actually pay rents on, and that's what that drives it. And this is why it puts UK in such a strong footing, because we have a country which attracts immigration. It's always a net, every single year it's a net migration in country, and also at the same time for us, the income growth is also on a steady growth level. So this drives rents, and in turn drives the house prices because of the rental growth.
But there's also increasing demand for rental, right? I mean, if you imagine the population is growing, so there is just more demand for rent. So. But I was actually quite, I know as a real estate person I shouldn't be overly excited about this, but the fact that these gaps are narrowing, so London used to be, ridiculously more expensive than everywhere else, that's actually now narrowing, which is actually, I think, more a reflection of the fact that, people are, I don't know, 20 years ago, you would have said, London is where all the action is, and there's not much going on elsewhere. But with all the effort being made to kind of revitalise the Midlands and the North, and all the government initiatives to attract companies to set up in those areas, actually this is now kind of narrowing out a little bit more. So London, I mean, it's still more expensive than everywhere else, but it's narrowing.
And I think, especially if you look at this chart, it shows one thing is that post-COVID, there has been a structural change as well. If you look at after 2022, I think all of us have seen there has been a shift because of work from home trends, like that a lot of people moved out of, across the world it's the same, moved out of London or the major cities, moved out because they don't have to be in every single day, like for the last 3-4 years, until this year people started coming back. But
we don't have a work from home.
We don't have a work from home, but no, other firms have work
everyone in.
Like for example, lawyers, right? Lawyers right now mostly work from home. It's the other way around. They don't go into the office that much, and this made a lot of lifestyle choices changes for a lot of people, that they don't have to live so close to work, because any late night shifts or any work that needs to be done overnight or so on, can be done at home. I think the technology shift has changed some of that mentality as well.
Yeah, absolutely. But I think the other thing with all of this is, remember, I always say that there's a supply-demand imbalance, and we haven't built enough homes for the past 30 years. In fact, more than that now, probably about 35 years. But what's really interesting is, look at this, planning approvals at record lows. I mean, despite the government saying it wants to make planning easier, it's almost giving with one hand, saying, yeah, we want to make things easier, but taking away with the other. They've made other parts of it ridiculously complex. High-rise buildings now have to go through something called Gateway 2. So anything more than 18 meters has to go through a very long process to get it approved, obviously from a fire safety standpoint, which is understandable, but the government introduced these rules before there was enough people trained to actually do the approvals. So there's a huge backlog. So a lot of housing stock isn't being delivered. But what's also then happening is the developers are still struggling with the planning process, while the government wants more housing built. The local councils are still not approving quickly enough to actually get this underway. And there's a lot of NIMBYism still, right? So, I think it's sad, because we need more homes. From a pure hard investment perspective, this works in an investor's favor, because there's not going to be a flood of new property coming onto the market. So one area where we're definitely seeing a bit of opportunity is there's been developments that have struggled to exit. We've seen it. In fact, we have a couple of those as well, and I know some of you are in them. As we've been working through it, we've been identifying the opportunities where actually, if you can acquire these at a good price, where the senior lender takes a discount on the loan, there could be potential upside. So over the next 3 to 5 years, we do see the values of these things increasing because of the lack of supply. If the planning isn't going through now, that means 2 years from now, there's not going to be that much on the market.
Yeah, I'll add a little bit onto that. I think partly, obviously, government is partly to blame with the planning approvals, but also if you look at the last 2 quarters of drop off, like in Q1 2025 and Q2 2025, in the last 2 bar charts and line chart. That also, like from what we see in the market day to day, that also reflects what we call like viability of some of the schemes, like and hence the planning submissions and planning applications, like how the developers are actually assessing projects, like what works and what doesn't, because the build costs have increased by so much, like which we'll go on to in a bit. Plus where the property prices have been stagnant for like 2-3 years, like it has caused a lack of a lower appetite for developers to actually go through planning and actually build projects and so on. It works in investors' favor because it will lower the supply going forward in the future. But this is also reflecting, we can see the market conditions changing. Not to mention a lot of developers and like have projects still stuck and haven't been recycling their capital in order to start new projects. That is kind of also reflected in this chart, I would say.
Yeah, and there is more information about the cost of building. Just very quickly, there's a chart here that shows things are looking slightly better. You know, in Q3 25 versus Q3 24, the number of proposed units has gone up, which shows that developers are putting in more applications. That doesn't mean they're approved, by the way. However, we should see this in context. It's still about 40 or so % below what it was back in 2020 or pre-COVID.
And in Q3, like I have seen a change. I think Jatin will feel this as well. Like in the market, like that lenders have been more aggressive and actually and lenders and investors, like it's a whole supply chain. Investors who do pre-planning plays, as well as lenders who do post-planning plays. Like they have turned a lot more aggressive in deploying capital and backing developers and backing projects and backing schemes, mostly because I think the rate cuts that had come in the last couple of months or last couple of quarters and the economy having stabilized and showing stabilization, like it gives investors more certainty and confidence to invest, and hence in Q3 we do see a lot more activity in the space.
Yeah, I mean it's you could call it increased competition, right? There is more money flooding into the market now, which is kind of positive for where we might be 6 to 12 months from now. So this is, I think, quite an interesting one. Do you want to take this one?
Yeah, so if we look at where the build cost and the sales price have been in the last 2-3 years, like one of the major challenges developers have is, especially in 22-23, when inflation was at 10-12% in terms of CPI, construction build cost inflation has also shot off the roof. And you can see that in this chart, that build costs have actually increased by like anywhere between 11 to 25% over the last 3 years, while at the same time we just saw also the other chart where selling prices haven't increased, like because interest rates are higher, mortgage rates are higher, people's affordability to be able to pay more for a property becomes much more challenging. So that capped the selling price, and hence developers are struggling to actually pass through the cost onto developers. What this implies is that development projects are increasingly not viable, or it is compared to 3 years ago. If you assess a new project or approach it, I look at it like the property prices, I'll get to the build cost and total cost, I get a 20 to 30% profit on cost. Now, because cost has gone up, prices can't be passed through to prices, my profits have been squeezed, then developers now have to take a choice of whether do I actually want to start this project at all. Like is it even worth taking the risk of doing it? So yeah.
Yeah, and look, this is a challenge that's hit the whole market. But if you think about it, there's only certain things that can move. You know, you've got land values, you've got construction costs, you've got sales prices. Sales prices can't really move because people can't afford to pay more. Construction prices are what they are. So what's going to happen is land values have to come down to actually make any development viable. we're starting to see some of this. As I said, the reason we're seeing potential like London developments again is because the sellers, the land sellers, are becoming a bit more realistic in what they can expect to get. Whereas in the old days, land sellers were able to charge a lot more and therefore squeeze the rest, squeeze the developer really in the middle. But there's, coming back to something Jacky said earlier about the funding in the market, this chart shows the various bits of commercial funding. This is commercial being non-private residential. So this is for, investments, rentals and so on. And you can see here the first half of 25 is already up to this kind of level, which means by the time the year's out, assuming that doubles, it'll be higher than last year. So there is more money flowing into the market. We're also seeing that on the other side. We speak to a lot of other lenders in the market. There's a lot of appetite to lend. Private equity firms are stepping up a little bit more. They want to deploy as well. And you'll see the increase in what's called other non-bank lenders. The non-bank lenders are becoming increasingly important in the market. Insurance companies are obviously lending directly in as well. But you'll notice that the UK banks element has not been as big as it was perhaps say pre-2007. So what's happened is that the way developments are all funded and the way projects are funded, commercial properties funded, is shifting. So it's no longer just about the banks. There are other entities coming in to provide the funding. And what we're seeing right now is an uptick in that funding coming into the market, which means that there will be more competition, which will drive down costs and hopefully make more development more viable. Anything else?
No, I don't think I have anything. I think this is where the trend is in terms of the non-bank lending. Like it's just because of regulation. Like where banks are highly regulated, and hence like the pace of approval are slow. The certainty of approval is also low. Hence a lot of borrowers, like whether it's you're borrowing for a bridge loan or for a development loan, like they turn to non-bank lending as an alternative for the pace of approval as well as certainty of funding compared to a bank.
Also, not to get too technical, but Basel III rules have kicked in, which means banks have to hold more capital against certain types of loans. So banks themselves have pulled back how much leverage they can give, which is actually great for firms like us because we step into that space where we can provide, if a bank has to pull back to 60%, we can provide from the 60 to 75% as we would have done previously anyway, but it just means we can take more of that loan by taking over the bank's position. So I'm going to move on to questions in a second. Just very quickly, we've had quite a few questions come in advance as well.
Yeah.
So I'll bring those up for you. But yeah, so the first question is, Jacky, you can answer that one.
Yeah, so there are some questions which are about our existing projects. We will separately answer them a little bit in terms of the questions. It's noted, we'll reach out to you.
Well, I think the one thing just to say is, we send out quarterly updates on every project. One of them was slightly delayed because we were waiting for an update. Yeah. That one it's done. I actually reviewed it this morning.
It's been signed off. It's going out very soon. So interested to understand this is the second question. Interested to understand your thoughts on resi landlords exiting the market following the Renters' Rights Bill. So what do you think?
Yeah, look, none of this is news to any of us. I'm a landlord myself. It's not news. It's just more pain coming for landlords. I think many landlords, myself included, have looked at how the hell do I get out of this now? Because the returns are just being squeezed. We're all seeing that. I think the slight issue is, anyone that's been a landlord for long enough knows that they can't really sell, especially if it's in their own name, because they'll be hit with a massive capital gains tax bill. So weirdly, you end up coming to the conclusion, you know what, I might as well just stay in there. I might be getting less money, but at least I'm getting money. Whereas if you sell, you have to find the money for the capital gains tax bill because, like most landlords, you probably leveraged that portfolio and already taken out that money. So I think we've already seen a lot of the movement that we're going to see. I think landlords will continue exiting the market naturally. I don't think we're going to see a massive crash or exodus. But I think also what's happened is rents have been going up to compensate for the additional costs. Obviously, there's going to be more pain coming with the Renters' Rights Bill. But like I said, I don't think it's going to be one big hit. I think we will see a slow deflation of the buy-to-let market. On the flip side, I talk to a lot of people in the market who are thinking of going in. Not traditional buy-to-let doesn't really make sense anymore, but a lot of people are still looking at the more alternative buy-to-let side, if you like HMOs. There still seems to be a hell of a lot of demand for that, and it's growing demand. So, it's a bit of both sides. I think a lot of people are also looking at property, seeing how they can optimize, number of rooms and things like that. So this is why I think the Renters' Rights Bill, it's might make things a bit tougher, but I don't think it's going to change. People that were looking to leave have already left or are in the process of leaving anyway.
So another question that was pre-written in was, is it worth investing in the UK with granted planning permission at an all-time low? We've seen in the past construction slowed down due to planning issues and rising costs. What is the difference here? So is it worth investing in the UK, Jat, with the planning conditions?
Sorry, I'm just going to read it again. Hello. We've seen in the past construction slowed down due to planning issues and rising costs. Well, construction has slowed down. If you read anywhere in the papers, there's less development being done now than at any time in recent memory, probably barring maybe COVID period. Obviously, we've lost a lot of the people that were doing the construction, but moving beyond that, I won't keep ranting on about Brexit, but moving on from that, the fact is the costs are high, construction companies going bust left, right and centre. So, it is a tough time to be a developer. I think the risks are way higher than they were. People think, greedy developers. Actually, developers are just business owners taking a risk on their own capital. So, I think they're being a lot more cautious, rightly so. And so, is it worth investing in the UK with granted planning permission at an all-time low? Well, that's probably precisely the reason you should invest. Because as I said earlier, with less construction happening, with planning not coming through, over the next 2, 3, 4 years, there's, demand is continuously increasing. Remember, you've got 500,000 kids coming out of uni each year. A lot of them are staying in the UK looking for accommodation. You've got immigration, coming into the UK. So the demand side is clocking up. The supply side isn't going up that fast. So to me, this is basic economics, supply demand, right? So you want to actually be investing in the UK because the dynamics just work. The one risk I would say in that is if supply and demand gets too far out of balance, then you start getting stupid things like, rent controls. But one thing we've seen recently in London, look, I'm all for social housing, but when the mayor set 35% social housing target on all London development just stopped. That's it. So in fact, not only are they undershooting their targets, it's just ridiculously low. There's no. People aren't even putting the applications through. There's just no point developing in London if you're going to expect 35% social housing because the numbers don't work. It's just not viable. So they've recently come back and said, okay, we're going to drop that to 20%. And what that tells me is a little bit of realism there, because a proper, don't want to say socialist government, but a proper Labour government would probably not move on that kind of thing. They'd want their social housing and so on, but end up shooting themselves in the foot because nothing would get built. So I think actually now is a good time to invest in the UK. We're at the beginning of what hopefully will be a bit of an upswing.
So another question is on the general of our the existing portfolio, the projects that we actually have on, versus new projects. We discussed about what's going to happen in the future. We've discussed about like where the market currently is. Are we seeing any upturn in existing difficult projects compared to what it was? Like, is there going to be any improvements based on the market supply demand getting more healthier and so on?
I mean, that's a really good question, but it's also quite unique per project. So, for example, for those that are in Westbrook Mills, you're seeing that actually there is a mechanism to come out of that one quite well, because we're about to take over the broader site. It's a good rental product and it's pretty much a finished building. Yes, there's some remedial works required, but it's pretty much a finished building. So that one works really well, 100%. That one, you know, I'd go into. There are others which are way further behind in terms of the development process, where they ran out of money or the cost shot up much earlier. They are still being kind of much more problematic. So I think the short answer is it really just varies from project to project, where they've got to in their cycle and whether it's an opportune time to step into them.
I'll add a little bit on that. I think, it really depends on where in the construction cycle it has got to. Like for example, the Westbrook Mills one is a very late stage, like it's almost completed. Like, because when it was underwritten during times where like the inflation chart we just showed went up to like 12%, like that's where developers couldn't manage the construction costs as effectively. And when, whether it's developers or us, when as lenders who underwrite the deals, like you would underwrite on a cost-based assumption, and when the construction cost went up during the build of the project, then the cost overrun will happen, and hence there will be a shortfall in terms of the cost, and causing problems into these projects, like because they run out of money to build it. In short, so these are still going to be worked out, because as we discussed earlier, you saw that the average selling price or the selling price of the homes hasn't increased, but the build cost went up. So there has to be a balance that needs to be found. So one day when selling prices we go back up, like then it becomes a little bit more viable. So I think that's the balance that it really varies across projects depending on where they are in terms of the build during that inflation shooting up phase.
Yeah, agreed. So look, I'm just conscious of time. I did say it would be 45 minutes and we've gone slightly over. I'm just looking at all the remaining questions, and I think actually we have answered all of them throughout the webinar. Anyone that is, sorry, can you see any uplift in the new build market going into next year if the rate does not reduce? Yeah, I mean, so we spoke a little bit about the rate potentially reducing, but I do definitely expect a strengthening going into the new year. So look, I think we've answered all the questions. We are always available if anybody does want to have a chat. For existing investors who are in existing projects, the regular updates will be going out anyway. And sorry, the TV's telling me it's going to turn off. The regular updates have gone out. But if you have any questions on those, let us know, and we're happy to jump on a call. So I think that is about it from us. Thank you, Jacky.
Thank you.
And thank you all for joining us. And thank you for the very nice positive comments a few of you have placed in the chats as well. And we look forward to seeing you next time.
Thank you.